Okay, so this case study today will explore transferring a business asset into a self-managed super fund. So we're going to cover off on the steps involved, the tax savings, the costs involved, and the other benefits. So the business asset in question is the land and property and building that two doctors work out of. It's currently held in a partnership structure, and we're investigating transferring it out to a self-managed super fund. So some facts of the case first. The partners in the partnership are over 55. The surgery building is approximately valued at $500,000. The rent per annum is about $25,000. We'll just assume an interest rate of 6.5%. Is there anything else that you'd like to know to investigate this case study?
No.
The partner's marginal tax bracket is 46.5%.
Do they already have the self-managed fund?
No, they don't. So we'll be setting up the self-managed fund from scratch. So what are some key steps in considering this option firstly? We need to consider the building and whether they have any borrowings against this building. To be able to transfer the building from the partnership into the self-managed super fund, there needs to be no borrowings ultimately unencumbered. So that's the first step for these clients, is to discuss with their bank manager whether the business asset secures any private debts. Then they need to look at setting up the self-managed super fund, transfer the property across to the self-managed super fund. Will the property be considered a taxable supply in that situation, or will it be considered a super contribution?
Super contribution.
Yes. So the property, when it's transferred to the self-managed super fund, is a super contribution, and therefore you put tax applied. Stamp duty will be payable on the transfer. What about capital gains tax? Just in a general sense, are there any concessions that we'd be looking at using?
Is it a small business, Jess?
Yes, the partnership is a small business entity, so we'll look to apply the small business entity concessions. So looking at the savings involved. So the building's transferred to the super fund. $50,000 of that super fund contribution for the year between the two of them, so $25,000 each. So they'll be receiving a tax saving of the tax deduction for that $50,000. That they wouldn't usually put money into super, these guys, either. So that's new for them. And then we'll be paying rent from the partnership to the super fund. So the super fund will be paying tax on that rent at 15%. So less the tax paid in the fund. Is there another tax deduction I've forgotten? So we've got them paying their super contributions. The fund is paying tax on the rent. What does the partnership get on the rent paid? Yeah. So then rent deduction as well at 46.5%, which is
11,750.
cool. So total saving is $23,000. So then we need to compare that with the costs involved in doing this transfer. So what are some of the costs? Transfer duty, and what value will I be paying transfer duty on?
the market value?
Yep, the 500,000. The costs on that turn out to be 15,900. We've got set-up costs for the self-managed super fund of 2,000. Legal documents for the sale, about 800. So you're looking at about $18,000 for the costs. Ongoing costs, we've got the ongoing costs of doing the processing for the self-managed super fund. Once these guys turn 60, can anyone see an opportunity for them?
So you can turn on the pension.
Yeah, so we turn on the pension tap in the super fund, and therefore we don't have this tax in the fund. So they've got the deduction, the rent in the partnership without the tax in the self-managed super fund. So
we've got a 5,000 saving this year.
So yeah, year one we've got 5,000.
5,000.
By the looks of it.
Year 2,
so they won't have the setup costs,
yeah.
and they'll have
They won't be having a contribution.
no. So they'll have 11 minus the 7.
Or 11 minus the.
Sorry, the
So you've got
tax
running
on
costs
the-
just of $3,000. Did you say before for the super fund?
Yes, $3,000 running
Yep.
cost for the super fund.
Yeah. So that's your cost, and then what's your tax saving
So 7,800.
being?
So the deduction for the rent,
Yep.
less the earnings, the tax on the earnings in the super fund.
So I guess the question is just whether you wait till they're 60 or whether you do it now.
Well, we're still.
If there's enough saving in there, do it now versus waiting till they're 60.
Well, certainly you're still ahead. $4,000 per annum by having shift ongoing at this stage.
So the cash commitment today, they're just cutting with for ongoing out-of-pocket the rent to pay the super fund, because that has to physically come across, minus the tax deduction that they'd get for that, so 13,000 they're going to have to find in cash cents. So the payback period is a year. They're going to get it back in that first year.